Lenny Butcher Group here at eXp Realty.
And we are, this is our home buyer seminar we do every Wednesday at 5 p.m. Pacific time, 8 p.m. Eastern time. We get together and talk about helping you get your first house or helping you move up into a new house. But it's a home buying seminar. We're here to help people buy houses. You can't really buy a house for the most part, most people can't, without some financing. Somebody who can help you lend you some of the money that you don't have, or maybe you have but don't want to use to get a better deal. And so today we're lucky to have Mike Mina from Augusta Financial. Hey, Mike, how you doing?
I am excellent. How are you, Bill?
I'm great. Now I see behind you about 6 basketballs. Is that how many do you have there?
There's quite a few. We're still waiting on cases for a couple of others because I just got this little addiction going lately.
When you don't even say the number, you know you're in denial about the addiction. Just FYI. As a former addict, I'm just telling you, I know that. I recognize that disease. And I think you told us you're in Santa Clarita, correct?
Yes, I am.
So tell us, where'd you grow up and how'd you get into real estate?
Grew up in San Fernando Valley. Basically, how did I get into real estate? I did this, 32 years ago, so I can't really remember, but I finished college and was trying to find something I wanted to do. I saw all these people with great cars. They used to come in the liquor store I worked in. So I said, you know what, this might be a great thing to do, lending or real estate. And I thought I didn't want to work the weekends, but now that I'm married, I don't mind working the weekends. So, it's one of those things. So I got into the business back 32 years ago, and it's kind of stuck for a little while now.
Wow, good for you. I'm similar. I'm a little before you actually, but same kind of story. So San Fernando Valley and lender. And so tell me a little bit about Augusta Financial.
So I opened that up in 1995. It's just a mortgage banker. We fund all of our loans here. We did about 1.2 billion in financed loans last year.
Wow.
My team did about a third of that, maybe a little more than a third of it last year. So we're out there hustling. I've got 5 people on my team that are licensed loan officers aside from myself. And then, I've got a few assistants going on there. And, I've got probably 35, 40 loan officers that work for the company now.
Wow. How exciting you built that. Well, congratulations.
Yeah.
So tell us about the there's a lot of different lenders, and we have had people on here from hard money and private lenders through conventional lenders and government focused lenders. What would you say is your product mix, and what would you say is if you had to pick one type of product that you do most of?
Product mix is A to Z. I mean, basically, there's nothing out there that we don't do. Someone called me today about a commercial loan, and it's not something that we want to do. We'll send them to a community bank or a local bank before we would want to do that. But if it's a fallout from a bank, we're going to jump all over that. So everything from a first-time buyer to the guy who's buying the $5 or $6 million house. We do VA, we do FHA, we do conventional. We do all of that really, really, really well. But we'll also do the bank statement loans, the hard money loans. And I think our niche is a bridge loan, and a bridge loan will allow people to go from, house A to house B without necessarily selling house A, or at least be able to make that non-contingent offer on house B before they sell their house A.
So I think that's what Patricia called me excited about and wanted to talk about a little bit on the show today. So go a little detail. So somebody owns a house, presumably they have equity, and they're going to borrow against that equity on that house and use that to make their offer stronger on the next house or make it a cash offer on the next house. Is that the game plan?
Yeah, correct. Like the client I talked to today, he was buying a house for $625,000. He had, house was worth like probably 400, or his house that he was selling, he owed 200 and he was going to get about 200 out of. We're able to extract about $130,000 now. So he could put his 20% down on that 625 purchase. And then he would qualify for both houses, the old house and the new one. In this situation, if he qualifies for both, and this client did, he would then be able to buy that new one, no problem. If he doesn't qualify for the new property, then we have other ways of getting them to qualify for that loan. Generally speaking, 9 out of 10 will qualify for both properties or find a way to qualify for those if that's what they need to do. But yeah, now he can make that non-contingent offer look a little bit stronger when he puts that offer in. And a lot of times they look at a contingent offer as someone who's got their house sold, 17 days have been released on the contingencies, and they still won't accept the offer because you still have to close escrow on that. And what happens if the buyer dies or loses a job or something like that? So we're just trying to, a lot of times my clients don't even use the bridge loan. They just get to take out financing from us, and that works out well too.
Okay. So, does the seller or the borrower then have to sell the property? Are they able to lease the property and rent it? Is that part of the lending? Is it's owner occupied on the current residence, so they can't lease it and they have to list it? How does it work on the current
Well,
residence?
so again, if they qualify for both properties, that property is going to get, put a bridge loan on. We'll put a 6-month or 11-month bridge loan on that property. There's no qualification on the departing residence. All the qualification is going to be on the purchase residence. So as long as they qualify for the purchase, they're going to qualify for the departing. But let's say, for instance, they do not qualify for the purchase. So these people make 130 grand and they can't qualify for both mortgages. So now what we'll do is we have to get a little bit more funky. If they have all contingencies released on their sale property, the property they're selling, then they can go ahead and qualify for just the purchase loan. We ignore all of the financing on the departing residence. If that doesn't work, we take it to the next level and say, okay, now you have to rent the property. Well, we can't do an 11-month loan on a rental.
Sure.
So we generally do a 5-year mortgage and they can make it a rental. So if they make it a rental, close escrow on the purchase, then it's up to them. Do they want to sell it or do they want to keep it? And then that's just kind of where we go from there.
This is becoming more of a issue, and I think for real estate agents looking for ways to generate business, and for buyers who've been struggling in the past year to compete, finding some creative ways to make these deals work are now available because of maybe a little bit less demand. And it's important for us to sharpen our pencils to figure out how to do these things, because I just had a client recently who he was confident he was going to sell his property. He bought a property. He got a loan through some company that borrowed the equity, made an all cash offer. And now he's looking at the tax consequences and saying, well, I'd really like to lease this property. We got the wrong loan set up on this one. So he didn't plan ahead, and he's ended up spending, I don't know, $15,000, $20,000 in closing costs to refinance if he wants to do that, or he's going to pay a lot of taxes he should have to pay otherwise. So, failing to plan is planning to fail. And I think these are the kinds of opportunities that we want to run through with professionals before we make these important decisions.
Right. One of the other niches, and I call it my mini bridge loan, which I think is really important, is we're seeing a lot of with the gas prices and the oil prices and the food prices and all the other things that have gone up so much. People have a lot more debt than they've had ever before.
Yeah.
Or not ever before, but in recent history, let's put it that way. And so they're running up to us and they're saying, oh yeah, we've got, I've got maybe 6 or 8 or 10 grand in credit card debt. And we pull the credit report, we're going, no, you got 32, 44, 28, whatever that is. And now their credit scores have taken a hit. So those scores have gone from 740 normally, where their credit history is perfect and smooth, down to 660 or 680. Well, that's affecting their loan rate on the purchase also. So they could go ahead and sell that property. And even if they sold that property, their credit score is not going to be up until they purchase until after they close escrow, pay the bills off, and they've already closed on their purchase. So we're giving what we call a mini bridge loan. It's usually 30 or 40 grand to them to get their credit score up the day that they list with an agent like Patricia. And then once they do that, then all of a sudden they're golden. We got their score up to 740. They list the property. They sell the property. By the time we close escrow, their credit score is already 740 or higher. And they're like, oh my God, this is so fantastic. I save 0.5% in rate or whatever it may be versus a 660 or 680 credit score.
Yeah,
And
I
this
think that's, oh, sorry, Bill.
Right.
I was just going to say, I think that was one of the reasons why I wanted to have you on the call too, because I haven't met a lender that's really offering that type of service yet. And a lot of homeowners are essentially going to sell, and then they are buyers as well. So a lot of people that I've talked to in the past, they have a lot of credit card debt, like you said, maybe 20, 30,000. And although they're making their payments on time, and there's that misconception that I'm making all my payments on time, so my credit score must be pretty good. And once they have their credit pulled, then they realize they have a lower FICO than what they originally thought. And there's a little bit of a shock there because they're not in the 800 range as they thought they were. They might be in the high 6s, but the fact is that when you have so much debt saddled under your credit, your score isn't going to be as high as you would like it to be, irrespective of the fact that you're making your payments on time.
Right. And you just think about gas alone. And, if I've got my wife and 2 kids that are under my contract, basically my money that we spend every month. And I filled my tank up today, and I know my wife fills up at least once a week. And you start adding that up, and now we're spending, $500 a week in gas, where we were spending $200, $250 a week in gas. So add that up, you're $2,000 a month versus $1,000 a month. And then you say, well, if I'm a W-2 employee, it's $1,500 in income earned every month. So now what else am I going to do except put it on a credit card and leave it on that credit card because I'm making my $80 or $90 or $100,000 a year? I have no choice right now until gas prices come back down.
Well, you could sell some of those basketballs and helmets behind you, maybe.
Well, I'm not in that situation right now, but we're okay. So, but no, I
Okay.
mean, you know, we can
I know your wife goes right there when there's a financial issue. I know that. I've been married long enough myself to know.
She doesn't complain about that, so that's okay. She's having a good time this week. So, but you know, we got to be concerned with that, and people don't see what their daily outlay is, and that doesn't include. You know, I went to a restaurant the other day, and the salmon on the thing was usually $26. Now it's $40. You know, like, oh my God, it's a 40% increase or something like that.
Mhm.
It's amazing how everything's gone up, and I think it affects everybody. And you know, that's the challenge of our market right now. On one hand, on the other hand, you know, I know people who've changed jobs and doubled their income. I know a young couple who they both changed jobs and both doubled their income in a year, and are smart with their money, and as a result, they're making a fortune. So I think there's two sides to that coin, and on one hand, it's challenging and scary, and on the other hand, it's opportunity. And if you're smart with your money and you earn money, this is the market of your lifetime. I think you know, it doesn't seem. Well, let me ask you, Mike. You're in an area where there's traditionally been more building than where I live. I live in West LA, but Patricia is in Downey, where there's not much room to build either for infill. Is there still building in Santa Clarita or more outlying than where you're at? And how the new homes, how's that faring?
They're building, but they're building slowly. And then you look at the builders and you talk to the builders, and we're involved in a couple of apartment buildings we're building right now. And so our costs are 20%, 15, 18, 20% that you're seeing.
Right.
So what are the builders doing? They're like, whoa, pull back a little bit. We don't want to go too fast here because prices are now leveling off and coming down just a tad.
Right.
But do you really want those construction costs being that high? So they're going to go slow enough to where they know they can make a profit, and they're not building at the levels that we were building in the early 2000s.
So and that's, I think, a difference in LA versus other parts. When you listen to the real estate news, there are markets, Phoenix, maybe Nevada, Las Vegas, where there's still very healthy building, and there those prices are being cut because the builders are more vulnerable. But where we are, we don't have new homes being built, so there's no builders with excess inventory they have to cut. Therefore, I don't think we're seeing the price reductions. Are you seeing in Santa Clarita prices going down? Now, price reductions are different. Often price reductions are increased asking price and they cut it down to where the market is. Do you see actually values going down in Santa Clarita, or are the prices maybe stabilized, but they're just not getting what sellers wanted for them?
I feel like if you took the peak of the market, which let's just say was January, February, March, and you took 10% off of that, your house will sell like that. But the problem is remember, interest rates went from 3% to almost 6%
Right.
in the middle of June.
Right.
So now we're coming back down. We're around 5% or a little less than that. So that's helped.
Right.
So you take your that 3% to 6% is a 30% increase in payment.
Right.
So people couldn't afford that, or many people can't afford that. So it's really put the stalls on it. So now people are like, well, I've got to lower my price. Sometimes it's not even price that's going to sell the house. It's got to be the right house for the people or whatever it is. Yeah. But yes, I do think that 10% has come off the top on a lot of those properties.
Wow.
They want to sell.
Wow.
But what is that? 10% off of a 30% increase that we had over the last 12 months, or 25, or whatever that number was. I know they said 19.3% average over the last 12 months, you know, March to March. Well, it's crazy.
Right. Well, that number, it's interesting because, and you've been around like I have been for a while, you know, there are things that went up 50%, like gas went up 50%, right? Houses can't go up that fast because even though there are a lot of cash buyers, not all the buyers are cash, and the appraisal kind of puts a brake on the increase in values. And that's why there's so much pent up demand, because even after things stalled out, the housing prices still didn't adjust as much as, say, the price of gas or the price of wheat or the price of paper. Now that's changing a bit. The prices of those things have come down a little bit, and housing prices have jumped up a lot. And so there's like a new equilibrium. But it seems, at least where we're at, the prices are flat. They're not going down. There's price reductions, but those are list prices that don't reflect the market price. Those reflect what sellers wanted. So it's interesting. So even in South Korea, you're not seeing that much of a price reduction, but you're saying you think 10% off the sales price? Like House X went down from 400,000 in March to maybe 360 today?
Yeah, I mean, well, we're talking the minimum house out here is probably 650,000. But if you looked at the peak of the market, you saw a house that was 715 as the minimum. And now it's like in that 650 range for for that property. But again, was that unique because people were just in those bidding wars through January, February?
Sure.
All of a sudden, they're like, hey, you know what? We're going to calm down. We're not going to buy that one. Another one prices at 649, and it goes like that.
Right.
And again, our inventory has gone up 4 times. We were at 150 to 200 homes in the Santa Clarita Valley early in the year, or until January, February, March. Now we're over 600 homes.
Oh, wow. That's different. So here in LA, maybe our inventory is up 20%, 30%. Still not, it's not about that number. So that's why we wouldn't see the same kind of price adjustments that you're seeing.
Yeah. And I always look at us as people say, oh, we're an upper middle class society, or no, we're not. We're basically middle class to, this is one of the least expensive areas that's safe to send your kids to school, all of that stuff in LA County. Yeah. So you look at this area, and then you look at the San Fernando Valley, and obviously that's a mishmash of everything.
Right.
You go to the city, completely different world. It's either really wealthy on the west side, or you go to the east side. If you're lucky, you can get out of there. So,
well, but the east, it's interesting. So the east side still, though, those prices are so much lower than the west side, closer to downtown and employment as COVID's come back in demand. And so those housing prices rose with everything else and have not come down. There's still demand in what you might think of the lower price areas east of, let's say, downtown, East LA and Downey and Norwalk. Those places are still, what do you see, Patricia, as far as housing values in Downey, in the greater Downey area?
Yeah, I mean, there isn't anything in this area that's, under 650. I mean, everything is priced well above, and I haven't seen too many price reductions in this area. Right. Usually, I mean, the school district is, one of the best in LA County, and considering that Downey is a city in itself, there's a lot of families that really are interested in moving to this area. There's a lot of parks here. There's a lot of community events that are really geared towards families and children. And so it's really a city that's contained in itself. I mean, we have banks, parks, recreation, schools, shopping, churches, restaurants. I mean, anything, Pilates, anything that you need, it's pretty much in this area. So
Downey is the Beverly Hills of the 562.
Yes, it is. And, a couple of years ago, there were some new condos. There were town style homes that are tri-level that were built on a main street here on Paramount Boulevard. And they were selling within, the 600 to 700 range. And this is for a townhome. So, the prices here have been pretty much holding steady. Yeah.
Mike, what happened today? It looks like prices, the interest rates, which had been inching down from over 6 down to 5.75, 5.5, 5.25. I think it was 5.05 on Friday or Monday, jumped up to 5.5%. Have you watched the Fannie Mae markets, and is there some particular news that has caused that, or am I misreading the market? Or
yesterday the Fed came out and said, or someone in the Fed basically said, hey, we think that we need another 50 to 75 basis points in September when we meet again. And I think that stirred the markets up. So the bond market was down 77 ticks yesterday. We pulled back and picked up 38%, 38 of those 77 ticks today. So we're really down a full basis point basically over the last 2 days of work. But we had a really, I'm telling you, we went from 6.25 basically down to about 4.75. And today we're sitting right around 5% on a 30-year mortgage with no points. So it's not bad. But I think that, obviously recession's fighting with inflation, and recession's been winning the last, 45 days, but inflation is still there. And that's one of the biggest concerns. And if inflation holds on, we might be in for a battle. My biggest fear, and it's still there, is that inflation takes us to 8%. And then when we come back down into recession, we're going to drop into the 6s and the 5s, and people are going to go, yeah, that looks pretty good. Well, those 3s are going to sit there forever, and the 2s that we put people in the last 2 years, those are going to be the people that are like, we're never moving. We'll add on 4 stories to our house before we move. And that's
I think you're right. I also think we'll start seeing a big increase in subject twos. I think you'll find that industry ramps up. There's products out there now where people service subject twos. There's products where people insure lender calls, doing sale on subject twos. And so basically that industry is waiting to burst once they get some clarity on where the market is. But I see already fits and starts in that business coming to us. one of the big issues, that as a real estate agent that we have and we struggle with buyers is we'll tell them, we'll refer them to a lender. And of course, they go online. And, if there's one place where the market's really dishonest, the industry news is mortgage rates. It's funny. I don't think you necessarily watch my YouTubes, but I've a couple of times caught, let's say, a news article saying, rates went over 5%, and there's a lending tree with rates in 3.75. And I said, one thing I know is you're never going to get 3.75 today from anybody. It just seems like there's like a liar's poker game amongst lenders. You've been around for a long time, so you must honor your commitments. You can't get away with that and stay in business. What's happening in the market? What do you see happening on commitments being honored, not being honored? How would you describe that process?
Well, let's put it this way. There's a bit of desperation going on out there. I get a call every day now from clients going, "Oh my God, I'm getting calls from lenders when you pull my credit report." And we use a fake phone number for a person's credit report, but if they have the information. Every bank in the world that was an online lender that was getting all these refinances is now calling our clients on a daily basis. Okay, turn on light. Okay, and then so what's happening is they're desperate that way. So they're calling and trying to give the lowest rate, thinking that volume is going to make up for the lost revenue they have. So we were at a seminar about a week ago, and it was all the mortgage bankers. And like I said, we did 1.2 billion last year, 100 million a month basically, and we're down to, I think last month was by far our worst month, which was about 35 million is all we did in business, which is normal. You got rid of that refi market, and now you're back to this. There were some lenders that were doing our volume that are down to $3 and $4 million a month in business.
Yeah.
Why are you even in business? So what they're doing is they're trying to drop the rate to create the revenue, but there's not enough revenue to do that. There's not enough business out there to do that because the refis were just this surge, and companies were laying off thousands or hundreds or whatever, depending on the size of that company. There's just not going to be enough volume in this industry with the players that are in it. So we've seen quite a few banks go under, but this is their desperation play when they put those numbers there and then they try to do the bait and switch and, oh, by the way, yeah, we locked your rate in, but we're going out of business. Sorry, we're done today. And that's it. So we've been here for 27 years.
Yeah.
We're not going anywhere. We are based on real estate business, purchase money business, and the refi stuff I always say is the gravy on top.
When I coach real estate agents, I always tell them, as far as working with a lender, you've got to get your buyer pre-approved with your lender, with a great lender who's going to be your teammate. And you tell the customer, look, if you want to shop, the time to shop is when we're pre-approved. And you have to shop actual loan options to actual loan options, not fantasy. And if you can get them to do that, the lender I work with is competitive. And what I find is it also gives the lender the time to earn the respect of the customer, because there's a lot of work involved typically to get pre-approved. But just to shop for a loan before you shop for the house is just such a tremendous waste of time. And I know why on-site websites encourage that, is they just want the clicks and they just want to sell the advertising. But it's just such a dishonest play to the customers. How do you must work with realtors, or have in the past worked with realtors, and your agents do now. How do you coach real estate agents on how they should set you up to be successful?
Well, I think the number one thing is you've got a guy who's going to be available 24/7. You go to a bank or you go to an online lender, you don't know if you're ever going to get the same people. Right. The other thing is in this area and in San Fernando Valley and other areas, once you talk to me, you're going to know that I know what I'm talking about. Or you talk to some lenders and they don't have no clue whatsoever. You ask to cross qualify them. I'll talk to a lender and they'll be like, okay, we got this. This is a piece of cake. This guy knows what he's doing. He's got it all down. He knows what the debt ratio is. And there's brand new people in the business that don't know that. And the fact that you're going to have our name on it and my ability to pick up a phone all the time is going to be an advantage to you in getting that offer accepted, because you want to get that offer accepted. And then we're not going to bait and switch anybody, because we need to be in business tomorrow. And you look at our Yelp reviews, we might have 1 or 2 out of 500 that are bad, and they're usually crazy people. So no offense to YouTube out there. No. So
you have 500 Yelp reviews. That's cool.
I don't know how many it is, but it just, it's a lot through the years.
Nice.
Yeah. One of the things that Mike said when I first met you was, I always answer my phone. And I've called him a few times and I'm waiting for it to go to voicemail, and he always picks up. Yeah. So, that's something that's, also very valuable, because these days, a lot of real estate agents, loan officers, they're just working off of text messaging. And that's not really an effective way all the time, to communicate. I mean, it's something that you really need to have a conversation about.
Well, and I think that we get too much, or people get too much into the texting and the emails. And, if you're just going to text and email, you lose the sale out of it. You lose the fact that you're not going to get all the knowledge that you need out of those clients. And I miss sitting down with my clients one-on-one in front of me. Nobody wants to sit with me anymore. They don't want to sit down and talk anymore. It used to be a realtor would pick you up at your house and drive you around to the 7 stops. And I go, okay, we'll meet you at the first stop, then we'll meet you at the second stop, then we'll meet you at the third stop. The game's changed a little bit, and I get it, but I like the old way a lot better. Maybe I'll just fade out with all the other old guys. I like that one-on-one. Let's touch, let's feel. What's your family like? Oh, I see little Susie and Johnny, and that's great stuff. Tell me a little bit about you.
I think that's your advantage. I mean, I know that's your advantage too. I've been around a long time. I've gone in and out of different markets. I was in the Inland Empire, moved to LA. Now I'm doing some more business back in the Inland Empire. And what fascinates me is the people who were successful 30 years ago are the ones who are still doing business today. Why? Because the business is more and more about relationships. And it's great to have technology, and most people have all that. But it's, at the end of the day, the differentiator is relationship. And I think it's really, really important. That's why I'm glad when Patricia mentioned you to have you on and get a chance to chat with you and introduce you to our group and our team, and to hopefully people watch this on social media and such. Any last questions, Patricia? I appreciate we've got a little long. We're kind of at the witching hour here for us. Any last questions, Patricia, you want to ask Mike while we're here?
No, I was just looking at my Facebook. I don't see any questions right now, but I think we've had a pretty robust call and covered a lot of different areas on financing.
Yeah, I really appreciate the time. Maybe Mike, you and I can chat sometime about what you do for team building and how we can maybe work together. We have monthly events in Diamond Bar for real estate agents. Love to have a lender. If you have some of your team out that way, perhaps to participate or something, and let's stay in touch in the future, okay?
That sounds like fun, Bill. I'd love to do that. And I travel anywhere to meet new people and get to learn a little bit about business. I love it.
Fantastic. Well, look, thanks so much, Mike, for being on the call today. And
Thank you, Mike.
And Patricia, thank you for being with us today. And Bill, thank you for being with us. Well, you're welcome, Bill. It's been a long day, folks. I still got a bunch of stuff to do. So this is our home buying seminar. We do it every Wednesday, 5 p.m. Pacific, 8 p.m. Eastern time. We stream it on Facebook and YouTube and our social media. Reach out to us if we can help you during the week. Questions or problems on home buying or real estate in general. Patricia, how would somebody contact you if they want to reach you?
Yeah, so the best way to reach me is my cell phone, and that's 323-365-9909.
And Mike, I forgot, Mike Mina from Augusta Financial. How would somebody reach you if they wanted to follow up more or learn more about your programs and such?
Yeah, you can try me on my cell phone also, 661-714-6258.
Fantastic. Or reach us and we'll forward you. And again, appreciate your time today. Thank you, everybody.